management accounting. Just to start our engine, management accounting is about presenting or modifying, providing data into a form where management can take a decision. There are various courses about management accounting which ensures a management should be in a better condition to take a decision or maximum utilization of whatever statements we have. Okay, we have discussed its functions. About the scope, we have discussed only about the financial accounting, how financial accounting helps in the management accounting. Okay, cost accounting we are going to discuss in detail today in a separate chapter on cost accounting. Budgeting and forecasting. Budgeting we have discussed. Budgeting is about investment. Okay, capital budgeting is about investment for a long term. So when we have to take a decision about any long term investment, what we require a management input. Okay, opinion from management. Maybe statements are there. Statement is about number. How do you interpret those statements? What are your future requirements? That decides your management accounting, or that is decided by management accounting. Suppose like if you go for any of the marketplace or online shopping portal, like you have Amazon, you have a Flipkart, you have a Snapdeal. Okay, if you go for their financial statement, you will see most of the companies, in fact all the companies are into loss, but they have not achieved their break-even point. Okay, why they are investing so much? Why they are heavily investing? While they are making a loss. Okay, even Baiju, which is considered as a pioneer or unicorn, they were into loss in 2017. Okay, they were into loss in 2017. So the question comes, why they are investing so heavily if they know they are into loss? They have not achieved their break-even point even after 7-8 years of their business operation. So the management accounting will take a decision. maybe they are not making a profit in terms of revenue, or maybe they are not making a profit in terms of monetary value, but they know they are reaching to maximum number of customers. They have reached their diversification in terms of product. They have reached diversification in terms of their customer. Now they are not only confined to urban area, but they are also having a presence in rural area. Okay, they are not only confined to high economic bracket, but they are also into a middle or low economic class. So now, like when management takes a decision, or when the management accounting takes a decision, it is not only about a revenue, or it is not only about a monetary value, but they will also consider what kind of expansion they can see in the near future. And see, the moment they will reach to their break-even point, that time is not very far when they will start making profit. Because what now they are trying to make people habitual for online shopping. And once you become a habitual for online shopping, and by this time you become a habitual from online shopping, they will already they will already compete, or they will already will able to close the petty shops or the small shopkeepers, because they will not be able to compete with these big players. Their pockets are very deep. They can they can invest huge or heavily to finish their competition. This is their target. Once they can finish their competitor, obviously they can charge whatever they want, or maybe they can make a profit in a better way, and they can achieve that break-even point as well as the huge profits. But these things are not visible from the normal accounting. Okay, here what you require is a management accounting. You will understand your expansion, you will understand your diversification, you will understand your width and depth of distribution. So different things you have to understand before you actually make a decision whether you want to go ahead with this loss making business or not. Like this is just one example of one case study where management accounting helps you to understand which are the things where we are on a positive side, which are the things where you are on negative side, and which is the most important. Okay, if diversification of customer, conversion of new customer, attracting a newcomer customer, or reaching to rural area, or micro towns, that is important, or whether making profit in initial time, that is important. Okay, this is what you normally see the difference whenever you enter into employment. There are two kind of companies you will see, one is MNC and one is local company. So normally whenever we discuss in a friends, like if somebody enters into Indian company, we call it a Lala company. Okay, it's not that all Indian companies are Lala companies, but most of the time you will see they are Lala companies. Like they will look for immediate benefit. Okay, if you promote any activity or you ask for any kind of permission, you want to run any activity, what message you will get immediately, what we are going to get out of it, or how much revenue increment we get. Like it's not about what we are going to get, but how much revenue increment we are going to get out of it, or what kind of benefits we are going to get in terms of monetary. Whereas if you send some mail regarding similar activity to MNC company, maybe they will not only look for a revenue benefit, but they will also look for sustainability, or can it increase our presence in a market? Can it increase our respect in a market? So there are various things which MNC companies will look whenever they spend the money. Okay, even if you can see there are many MNC companies like if I have to take you for Abbott International, okay, which is considered one of the best company to work with. It is employee oriented company. From last 5 to 6 years consecutively, they are getting a prize as a best company to work with. Okay, so obviously it's best company to work with. But if you look at their balance sheet, they are into loss. They are into loss from last 20 years. Okay, since they have started their FMCG segment. Maybe they are a very big player when you consider the same company in terms of pharmaceutical background. Okay, but they are making huge loss in FMCG. But still they are hiring employees. In fact, they are hiring employees with a high budget employees. They are hiring employees from top FMCG companies. Why? Because now they are not looking for immediate profit, but what they are looking to increase their presence, to establish a brand positioning in a consumer's mind. Okay, changing their consumer behavior, reaching to maximum people. Like when they launch their product, like Pediasure, okay, which is a competitor of Bonvita, Horlicks, and hence Complan. There are many other players too, but their major competitors are these three players. Okay, so Horlicks, which is one of the costly items, they sell around it's 400 rupees kg. Okay, 450 rupees kg. Maybe like there is a little difference in price, but it's around that price. Okay, but when you go for a Pediasure price is 1200 rupees per kg. So it's almost three times. It's almost three times of Pediasure price of Horlicks. Okay, but still because they had a strong capital budgeting planning, employing planning, forecasting, a better financial accounting, they are not worried about going into loss for another 5 10 years. But still they want to continue with their business. In fact, they want to move more aggressive. This is what we mean by management accounting, utility of management accounting. See, while we are studying accounting management or financial accounting, we are not interested into we are not interested into how to manage entry, what is the meaning of a particular entry, or where to put this particular entry. So this is something which is done by either a CA, or this is done by MCOM guy. Okay, we are interested into management accounting, or we are interested into a mechanism behind accounting system. Okay, so maybe we are not aware about a particular term, or maybe we are not very good at at a particular terminology. But what we are good at, managing our finances, managing our accounting. Okay, or making analysis from whatever statements we are provided with. Being a management student, you will never have to prepare a balance sheet. Okay, you don't have to prepare a balance sheet. What you have to do, you have to make analysis from balance sheet. Okay, so you don't know, you are not supposed to know how to make balance sheet, but you are supposed to understand how to analyze balance sheet. Okay, you are not going to work as a cook in a hotel, but you are going to work as a manager, or you have to, like, even if you have not prepared particular dish, you should be in a condition to explain, or you should be able to promote that dish to your customer. Okay, being a manager, like what is the advantage of your hotel, what is the advantage of your that particular dish. So this is your role. Your role is not to cook, or you are not going to make any balance sheet or any of the statement. What you are going to do is analyze the statement. So understand your role, and with this role, if you go move ahead, maybe that will be more easy for you to understand why you have to read accounting management, or what is the importance of management accounting. If you go into detail like solving a problem, or if you go into detail about understanding each and everything about entry, or how to make a balance sheet, maybe you will ultimately land up wasting a lot of time. So I suggest be a manager and understand what is a requirement of this particular subject, or why we are studying this subject. Tomorrow we are going to start IT. So even in IT, I'm not IT expert, and you are not expected to be expert in IT or in accounting terminologies or accounting subject. What you are expected is you should have a knowledge about everything. Okay, somebody who is entering working as an engineer, or is engineer and working into say manufacturing industry, like a mechanical engineer. So maybe that person is expected to know all the technical knowledge about the manufacturing. Or somebody is MCOM or PhD in commerce, he or she is expected to know all the accounting techniques, all the accounting entries, all the accounting heading. But we are not expected to be expert in one segment. We are not expert of any segment, but we are jack of all. Okay, we are not expert, we are generalist. MBA is not about specification. Like, have you ever heard somebody is getting a job into marketing because he or she has X graduation background? No. When you are entering into a marketing field, or when you are entering into a finance field, they will not ask you about your background. What they will ask, whether you have a capability to analyze things, understand things, or make out the meaning, or can you convert information into knowledge. Again, you are not going to prepare data. You are going to prepare information, from that information to their knowledge. Okay. So again, it will be easy for you if you understand the purpose behind the subject. Okay, the objective behind that particular subject. Because in last class, or sometime I feel you are going into much detail to understand something which is not required for you. Okay, you have a limited resources, and that resource is time. Most of you are working, or maybe you have, like, you are doing a part-time MBA. You won't get the time from your housecore work, or many other commitments are there. So when you have a limited time, limited resources, I will suggest go for specification. Okay, understand what is expected and spend time in more productive way, rather than going for something which is not going to ask in an interview, or not going to be helpful when you enter into a job market. Okay, management accounting, about taxation, we have discussed. There is a tax avoidance and tax evasion. Okay, tax avoidance is there is something legal and there is something ethical. Okay, legal is which is legally binding, and you have to comply with that. If you don't comply, maybe you have to pay repercussion, or some kind of punishment. But when you don't follow ethically, maybe there will not be external punishment, but there will be internal punishment. Your conscience will say you are not doing well, or you are not doing a right thing by not paying taxes. Okay, because that tax money is going to help those poor people, or this will give enough revenue to government, which they can spend for some of the social activity. So tax evasion, okay, tax evasion is expected, but not tax avoidance. Okay, tax avoidance means you are not paying taxes at all. But you being expert of management accounting, you can manipulate your accounting, or you can use different headings to ensure that you save taxes. Okay, like we have discussed about the one case study. Those companies which pay higher basic salary, okay, obviously they're supposed to pay higher taxes, because you pay taxes on your basic salary. But suppose you are getting something as an allowance, like traveling allowance, okay, a convenience allowance. Here you don't have to pay taxes, or medical allowance. You don't have to pay tax on this. So there are many companies. What they do, they reduce their basic salary, and what they give them more of a convenience. Okay, so in this way, their employees will not have to pay a bigger tax. But there are many companies which think, we have to provide a bigger taxes, their bigger basic salary. Bigger basic salary may have to pay comparatively higher taxes, but again you get a more benefit in terms of PF, because again your PF is decided based on your basic salary. Higher the basic salary, higher will be PF. Higher will be PF means higher will be saving. Okay, so there are various ways you can understand the taxation policy, and how you are going to go ahead. That is based on company's core policy. Okay, there are many companies which look for higher saving rate for employee, so they obviously give a bigger basic salary, and bigger basic salary will attract bigger PF from employee contribution as well as employer contribution. That will ultimately lead to saving of money. And again, since you are paying a higher PF, you will save taxes. That's why that is come under 80cc. So people intentionally open one or two PF accounts just to save their money. Okay, since you invest in a PF, you don't have to pay any taxes on that particular PF account. So this is what we call, like recently government had increased a PF limit as well. Like you can account two accounts or you can increase your PF limit. So this is recently announced. I don't know what is exactly limit now, but yes, government has increased some limit for PF account because that has a dual benefit. One, you will save your tax money, and second thing, government will get this as a contingency fund. Or government will get this as a public fund, which government can invest whenever government wants, because there is a limitation, like you cannot withdraw your PF within like before 5 years. If you withdraw, you have to pay complete taxes. So since it's a comparatively long-term investment, government can use into infrastructure building or somewhere where government needs funding for a long term. Okay. So taxation policies which have utility for government, which has utility for society at a large, and it has a utility for businesses. So based on your priority, based on your objective, you decide what kind of taxation policy you want to move on. And that is again part of management accounting. Inventory control, again, inventory control management based on different inventories. Okay. Like we have discussed about just in time. Okay. Just in time is a technique which you use in the manufacturing industry. Okay. But again, management accounting provides all the raw material, monetary, paying the bills which you require for raw material. So again, management accounting or accounting has a role even in a manufacturing. So inventory control is, instead of having surplus inventory, or instead of having uh, uh, extra inventory, what you follow certain techniques like just in time technique, where you call for inventory, or you ensure there is continuous availability of inventory on your phone call, or maybe at a shorter period of time. So just in time ensures you have a raw material whenever you require for a production. You don't have anything as a surplus, or you don't have in advance inventory. So this technique also saves money, saves space, saves time. Okay, or saves like wastage. Statistical method. Okay, based on different data, you apply a different statistical methods. Like we have discussed, we are going to discuss about the ratio analysis now. This is also part of statistical method. You use different diagrams like a bell shape diagram. Okay, you square Python technique. You have a probability method. There are various methods you apply, in a statistical way. T-test, F-test. There are various statistical methods you apply to understand your financial status, and you try. Like these are the things, statistical method. You will learn into a statistical subject, or like quantitative technique wherever you have in one another semester. Okay. So this is a statistical method you use in a management accounting to reach a different conclusion to make a decision. Okay, interpretation of data, again we have, this is the core of management accounting. Like whatever data you are not looking at just numbers, but you have that freedom, you have that understanding to analyze or interpret the data to make sure that you take a right decision. Reporting to management is whatever decision or whatever expertise you have in analysis, you will communicate that, like you have received data, you have converted that to information, and ultimately, since you are capable of converting that information to knowledge, you directly pass knowledge to your senior management. Okay, you will not pass on the same information, because ultimately, like it's a hierarchy. So what is the job of hierarchy? What is the job of manager? Is to simplify the things for their subordinates, as well as to their seniors. Like whatever message they receive, they should not pass similar to their subordinates or their superior, but they have to manipulate in the required manner which is more suitable for their subordinates as well as their seniors. So whatever they are getting from their subordinates, they simplify it, they convert it into a more readable or more easily understandable manner, and they pass on to seniors. Whenever they get any message from seniors, what they do, they just simplify it. They try to convert it in a language which is easy to understand for the subordinates, and then they share with their subordinates. So again, this is the scope of management account. Okay, integrated financial planning, like you here integrate everything, whatever you know about the financial, and you make at a one place. Okay, so that you will have a better planning and better certain planning. Okay, based on certain logic and analysis. Like we have discussed, there is a difference between forecasting and guessing. Okay, forecasting is based on proper planning, it is based on some historical data. Okay, it is based on certain techniques which you apply to make a planning. Okay, so that is what we call a forecasting, which is backed by logic. Whereas guessing is something which is like what we call, this doesn't have any basic, and that is based on your own common sense. And there is a high probability that you will not reach the goal, or you will not have what you have guessed. But there is a high probability, or there is a high certainty that whatever you have forecasted will convert into reality. Okay, so integrated financial planning can be made by using a different inputs, that is supply planning, distribution planning, manufacturing planning, material planning. How much material you require, for that how much raw material you require, what kind of labor you require, how much electricity you consume, what kind of equipment you require. Okay, manufacturing planning, obviously what is your target to manufacture, how much manufacturing you are looking, how much raw material you require. So you have to you have to achieve a synchronizing, or you have to achieve a synergetic action between different departments, or between different states, to add value to it. Like, since you are aware about end-to-end process, you are making a planning about right from what raw material you require to what finished product you are going to get, and how you are going to sell it, sell this product, and how you are going to receive or money or revenue from the selling the product, how much time it will take to receive that fund, or what time it is going to be a working process, how much time it requires to sell, how much goodwill you require. So you are in a control of everything when you go for integrated financial planning, right from planning to manufacture. Okay, right from sourcing for a raw material, work in progress, or manufacturing, and ultimately recovering of the money what you have sold. It's not only about selling, but also you have to ensure recovery of that money. So that everything comes into integrated financial planning. Then only you will be able to, like if you have to decide, suppose you have some payment to due on a next week. So obviously you also have to pick how much money you are going to receive from your data. Okay, so if you have that, like cash in hand, working process, okay, working capital management, so you apply a different techniques, you apply a different things to manage those funds which you have to give to creditor. So this is a part of integrated financial planning, where all the activities are clubbed together to ensure there is a smooth flow. There is a smooth flow of financial planning from one department to other department. Okay, ratio analysis. First, about ratio analysis is about comparison. Okay, or comparison, or trying to understand what is a relationship between two things. Okay, like we have a relationship, like resource available and population available. So this is how we understand how much we can give for a particular activity. Suppose there is an analysis that 1:4, that every person is going to get a 4 chocolate. So obviously we will clear about our resources, and we are clear about our requirement. So we can make a financial planning based on ratio analysis. So ratio analysis helps us to understand availability of resources and availability of and how much we require to ensure there is a smooth flow of distribution. This is a ratio analysis, and utility of ratio analysis. We'll see some of the ratio analysis to understand utility of ratio analysis. Ratio analysis types. Liquidity ratio. So liquidity, we know, to ensure a smooth flow of business, we require certain liquidity, that is cash in hand or cash at bank, or some assets which can be easily converted into ratio. So there can be current ratio, and there can be a quick ratio. Okay, current ratios maybe that is having a comparatively longer time, but quick ratio is immediate. Okay, so even a liquidity, you understand there is like how much liquidity you have, or what is your liquidity ratio. Okay, liquidity ratio can be for a short term, for a long term. So based on your liquidity, you take action. Like, suppose you get a deal, and that is a very good deal, and you have to make a decision whether you want to apply for that particular deal or not. That depends on your liquidity ratio. If your liquidity ratio is high, obviously you can go for that activity. If your liquidity ratio is low, you have to think about, or you have to ask for a time for that deal. Like in terms of banking, this liquidity ratio is mostly used in the banking system. There is something called time and demand liability. Okay, time and demand liability. So what is demand and time liability? whenever person comes to your bank to withdraw money, they will not inform you in advance. Okay, they will suddenly come and they will fill the form and they will ask for money. So how will you come to know that how much money we require today so that we will be able to serve all our customers? So that depends on your time and demand liability. Normally there is a trend. There is a trend, which bank understand. And when somebody is coming to withdraw money, at the same time there are people who are coming to deposit their money. Okay, so you understand the nexus or the ratio between how much people are coming to deposit money, how much people are coming to withdraw money. Okay, once you understand this ratio and if you realize, okay, you suppose you want to maintain a 1.5% of ratio. That means if 1 rupees is coming as a deposit, you should have 1.5 rupees to available for those people who are withdrawing money. So whenever you are clear about your ratio, if you look at historically how much money we are getting on a particular day and how much money we are going to going outside, that is cash inflow and cash outflow, and what ratio you want to maintain. On a higher side, you have noticed that a max to max on a particular day, 1.5% of the ratio, liquidity ratio is enough. So obviously what you do, you will maintain that ratio. And the rest of the money, what you have, you invest somewhere. Either you give as a loan or keep this as a reserve with RBI to get repo rate. Okay, to get a repo rate, that is some kind of interest because you have already committed interest rate to your depositors and you have to pay that. So it is a wastage of money or it is wastage of resources if we have ideal money. So to ensure that we are able to serve all our customers at the same time, we'll be able to make a profit from surplus liquidity. You need to understand the ratio. Okay, like how much money you require to conduct your everyday business. Okay, to how much money you require to conduct your everyday business. That is also about depend on liquidity ratio. Okay, maybe something you are buying on a regular basis and you're selling on a regular basis. So how you ensure that how much money you require to buy and how much money you are going to make by selling a product. That is also decides your liquidity ratio. How much assets I have? Maybe my business is having suppose 100 crore of assets, but how many of them are liquid assets? Okay, how many of them I can convert within a short period of time? Okay, that is called a liquidity ratio, and liquidity ratio is important to ensure you handle your day-to-day business smoothly. Okay, even suppose working like there is a low position on cash, okay, or you're short on cash, so you can use your liquidity ratio to immediately liquidate that assets and you can convert that asset into a cash in hand. Okay, so you don't have to worry like suppose suddenly you get a big order or suddenly you have something to give it to creditor and you don't have fund, some uncertainty is there, some kind of contingency fund you require. So obviously there you have utility of liquidity ratio. How much of your assets are into liquid assets and how much of your assets are into long-term assets. So this is how you decide your position and you understand or you take a risk or you take any business decision based on your liquid ratio analysis. Profitability ratio, obviously how much you are investing and how much profit you are getting. Okay, so we have discussed in a market normally it is expected at least you should get a 24% of returns on your investment. This is a normal expectation. Okay, you should get 20 to 24% of returns on your investment. Since you are putting your hard work, you are giving one full-time employee, or you are investing your time, your energy into business, you expect 20 to 25% of 20 to 24% of returns on your investment. Okay. Otherwise, if you expect a 7 to 8% without spending any energy, you can go to bank. Or there are multiple ways you can invest for a 10 15% of return, comparatively safer way. Okay, but mutual funds and something like that. But if you are investing energy, if you are investing your own time into it, obviously you expect 20 to 25% of returns. So how do you calculate your returns based on your return on investment (ROI)? Okay, continuously, regularly, you calculate your ROI to understand how much money I'm putting into my business, how much is the expenditure, what is net revenue I'm getting, what is gross profit, and how much expenditure I'm incurring, what is variable expenditure, what is fixed expenditure, and ultimately what you left after paying taxes and everything, what you left is your net profit. So you always calculate if I'm investing 100 rupees, whether I'm able to make 20 25 rupees after every year analysis, or like there is a ratio called like investment is 100 rupees and return is 24 rupees, that ideal ratio, that ratio is considered as comparatively well, like 25 into 3. 25 as to 3 ratio is considered as a decent ratio. But if you are not able to make that ratio, then obviously you have to think about either changing a business or making changes in your existing business. Because profitability ratio is again input. Like either you can make a profitability ratio based on your gross profit, that is ultimately after selling a benefit, after selling your goods, what benefit margin you are getting, or you can go for a net profit. Okay, net profit ratio excluding all your expenses, excluding all your taxes and everything. That is your net profit ratio. Operating like day-to-day business, when you operate your business, what business you are making at a short time, that is operating business without considering your fixed cost. Okay, return on capital employed, like whatever investment, complete investment you have put into a business. Like maybe like yesterday only I was having a discussion with one of my friend. He was saying he want to start a business. He want to start a business, and for starting that shop, actually it's a retail shop, supermarket. Okay, to start a supermarket, maybe he has calculated there is X requirement, X amount of capital he required for business purpose. So he have calculated all the expenses, but he have not included rent because it's own shop. Okay. So here again, return on capital means capital is your shop is also your capital. Capital doesn't mean only a money. Capital means all your assets which you have included. Maybe you have even it's in your own shop. Okay, where you don't have to pay rent. But what about opportunity cost? Opportunity cost in the sense, suppose instead of running your own business, if you would have given it on a rent, you would have made some profit. So this is actually a loss for your business. Like you are not giving that shop on rent to other person and you are using it. That means actually you are losing opportunity cost. So you have to include even that cost into your when you calculate your return on capital. So capital is not only about the money, but it is also about all the assets which you include into your business. Okay, maybe like there are people who also include, they can include, like if I would have worked somewhere else, like if I'm making a 20, suppose you have a rent of 30,000 rupees, okay, and you are investing 1 lakh rupees into that business, and ultimately what you are making is 40,000 rupees. Okay, here you can see you are making 10,000 profit, and that is decent. But if you understand, like you are investing your own energy into it, or you are giving complete day to your business, in that case, even if I work somewhere else, I will make 20,000 rupees. So if I'm making 20,000 rupees by working somewhere else, so why should I take a risk? Why should I run a business, or why should I give a complete? Why should I give a complete day where I don't have any Sunday, where I don't have any holiday, or that complete risk lies on my shoulder? So rather than this, I can go outside and make it 20,000 rupees. Okay, so this is how I'll get a rent of 30,000 rupees as well as I'll make a 20,000 somewhere else. So it is my profit is 50,000 rupees. But if you start a business and if I do a business, I'm getting only 40,000 rupees. So I'm able to recover my rent, that is 30,000 rupees. But I'm not able to recover my salary, which I'm getting as an opportunity cost. Okay, so return on capital, that also includes a human resource. So you have to calculate your own cost. You have to calculate the cost of rent or whatever assets you have included. That is called opportunity cost. So while calculating profit ratio, you understand how much I'm giving and what I'm getting. Okay, this is also called input-output ratio. Okay, how much input I'm putting and how much output I'm getting. Why most of the farmers are not interested in agriculture? Because it has affected their input-output ratio. Initially, maybe their input-output ratio was very good, but after green revolution, like everything is going for hybrid, everything is dependent on pesticide and chemicals, fertilizers, costly seeds. Okay. So now, like initially, people were based on depend on organic farming, where they used to take seeds from their last crop. Most of the time, they used to use natural resources like cow dung and other methods like to manage their pesticides, or they were naturally dependent on whatever they have around them. But now they are buying everything from market. Seeds they are buying from market, that too from multinational companies. They are buying fertilizers, they are buying pesticides, they are buying water sources from outside, irrigation equipment. So they are like for a market, even for a market, they are going to district place or some APMC. So now it has increased their input cost. That's why profit has reduced. Otherwise, actually our production has increased. Our requirement. Our requirement is 240 million ton a year to feed all our population, but our production is 278 million tons. So we have a surplus production, but still we are saying our farmers, maybe their output is okay, they are increasing output, but in the context of the to extent input cost has increased, that is very high. So that's why we are saying we have to calculate profit ratio to understand where we are standing. Okay, return on another example of our return on capital employed. Okay, we have discussed about disguised unemployment. Okay, disguised unemployment in the sense, suppose there are two brothers who are working in a shop and they are making 100 rupees. Okay, but some third brother boy joins their business and he, like when they calculate after adding that person, they're again making 100 rupees. So that means initially each person was making 50 rupees, but now each person is making 33 rupees. Okay, that means we don't require third person in that job because marginal productivity is 0 rupees from that particular person. So rather than investing that or including that person to save business, can we send that person somewhere else where may not be he will not make a 50 rupees, but at least he will make up a 20 rupees, 30 rupees. So that will lead to 120 and 30 rupees profit for that family. Okay. So when you calculate your return on capital or return on your investment, you also add your capital or your opportunity cost. Okay. Another ratio, that is solvency ratio. Suppose tomorrow you have some debt. Okay. You have take some loan from bank. So what is your solvency ratio? Suppose even if you not get your revenue return from your debtors, but still do you have enough funds to repay your loans? Okay, if you have started a business, like you have taken a loan of 10 lakh rupees, but somehow you will not be able to run that business, and whatever machineries you have bought or whatever goods you have bought for that 10 lakh rupees gone into a drain, and you have not able to use these assets. But do you have 10,000 to 10 lakh rupees to repay your loans or not? So this is a mortgage. So why companies look for a mortgage? Because this is to ensure your solvency ratio. Even if you are not able to repay your loans from that particular business activity, do you have a capacity or do you have an alternate way to repay a loan or not? Okay, that is how we decide a solvency ratio. If you are taking a 10 lakh rupees ratio or lakh rupees of a loan, show me a mortgage property which has equal value or maybe little more value. Okay, this is how a solvency ratio works, or this is how much money you have invested into your own business, how much is your own business, how much is your own money and how much is borrowed money. Okay, that shows if something is like if you have your own money or a higher percentage of your own money and you have borrowed with a little from outside, then obviously there is more trust of investor into your business because you are not dependent on somebody else's money. You have enough solvency ratio, or if you have you are into condition where you can repay your loan even if your business doesn't work. If your business doesn't work. So this is about solvency ratio, turnover ratio. Okay, turnover ratio is how much is your sell, how much of turnover you are doing into a particular year. Okay, fixed asset turnover ratio, and how much business you are making on fixed asset. Inventory turnover ratio, how much is your inventory and how much is your actually output, or how much you are selling and how much inventory. Suppose you are having a more inventory, like suppose there is a garment shop which is having a 50 lakh rupees of stock, that is inventory. Okay, and yearly sell is only 20 lakh rupees. That means 30 lakh rupees of stock. Either it's a dead stock or it is non-movable stock. So that is not expected. So what you are expected, you should have a 20 lakh rupees of inventory, and you should have a 50 lakh rupees of sale. So how can you manage a 30 lakh rupees? That is a daily purchase. Okay, that is a continuous turnover. Then you can say like I have invested 20 lakh rupees into a fixed asset or fixed inventory. Then I have 30 lakh rupees into rotation, and this is how I like 20 lakh rupees into continuous rotation, and including my profit of 10 lakh rupees, I have a 50 lakh rupees of turnover. So this is how you can ensure what profit you are making. It's not that every day you are calculating. Okay, I made today's counter is 50,000 rupees and I get 20% margin from my stock. So that is like from 50,000 rupees I made 1 lakh rupees a day. Okay, sorry, 10,000 rupees a day. So this is not a right way of calculating your profit. You have to calculate how much is the turnover ratio, how much of assets you have, how much you have invested into stock, and ultimately how much money you are making on a daily basis. Then you will come to know, like you have invested 20 lakh rupees. There is opportunity cost associated with that 20 lakh rupees. If you are making a 5,000 rupees or 10,000 rupees every day, that means you are making around, okay, 2 to 3 lakh rupees this month, and you have invested 20 lakh rupees into the, that is very very good return. Even if it's 2 lakh rupees, that means every month you are making 10,000, 10% of it. So that means ultimately at the year of the end, you are making a 120% of turnover ratio. So this is considered as very, very good ratio. Okay, like we have taken a raw example. Actually, 120% of returns is too good, too good. Okay, normally people have a return of 24 to 30%, and that is considered as very decent. If something you are making more than 30%, that means you are doing a miracle, or you are having a very, very good business. Because within 3 years, even if you consider 33% of returns, within 3 years, you are going to double your investment. Okay, or you are going to double your benefit. Like maybe you have investment 10 lakh rupees and you have 33% of return every year. That means within 3 years, your 1 lakh rupees is going to become 2 lakh rupees. Okay, so this is how we calculate some of the ratio, earning ratio, like profit earning ratio, how much earning you are having. Okay, earning per share, like whatever share you have distributed, maybe you have sold share at 10 rupees, but like you are making a profit, and now every shareholder is making, say, 12 rupees per share. So 2 rupees per share margin is also considered as a very good margin for not only for your shareholders but yourself, because you also hold some of the shares on your name. Okay, so this is ratio analysis and types of ratio analysis. Why we have to go for ratio analysis? We have discussed some of the concepts with the help of ratio analysis. We have discussed some of the examples, and especially for those people who are not from a commerce background. Okay, or those no, those who are from a commerce background but like never read something into a management concept, or they have just studied commerce just to understand the things or just to get a marks. For them, we have discussed some of the case study to understand in a better way, a practical example, or a pragmatic things which they can use into their own employment or their own business. Okay, liquidity ratio. We have discussed liquidity ratio. Now let's discuss some of the concepts in detail. Liquidity ratio give an idea about company's ability to convert its assets into cash and pay its current liabilities with that cash whenever required. There is a formula to understand how you calculate your current ratio. There is a quick ratio. It is similar to the current ratio. It just illiquid assets like inventory are not considered. Okay, some of the stocks which you cannot convert into liquidity, that stocks are not considered. Okay, cash ratio only includes cash and cash equivalent in the numerators. Okay, defensive interval ratio. So there are some ratios which you can understand which are a part of liquid ratio or liquidity ratio. Self-explanatory. Even if you read afterward, you will get it. Like we have discussed in detail what is liquidity ratio. We have discussed some of the example about the liquidity ratio, how to use liquidity ratio, and whenever you have a surplus liquidity ratio, how to manage that surplus amount. Whenever you have short at liquidity ratio, how to manage that short term, or what are the plannings you have to ensure in a place before you actually face shortage of liquidity ratio. So we have discussed this. Profitability ratio, we have discussed. There is a formula, there is one case example, and ultimately you have actual calculation about how to calculate gross profit divided by sales. Okay, how to calculate net profit, net income, that is after deducting your tax and all the expenses. What income you have, that is also your net profit. Operating profit margin, operating profit divided by sales. Return on assets, net income divided by total assets. Return on equity, basic earning power. So some of the examples are given, some of the terms are given, formulas are given, and how to calculate actually these things given. And we have discussed some of the cases, some of the live and pragmatic examples to understand how to calculate profitability ratio. Okay, importance of ratio analysis. Why we have to go for a ratio analysis? Enables the banker or lender to arrive at the following factors. Liquidity position, like we have discussed. What is a liquidity position? How much money you require to you need to have, or you require to have at any given point, because your customer is going to come, can come anytime to withdraw money. tell you one case study, very interesting case study, which affected ratio analysis or which affected all the banking segment. Okay, uh, there was I forgot the bank name, but there was a case like there was a rumor in the market that this particular bank is going to close down all their operations. Okay, particular bank is going to, I think Bank of Baroda. Okay, there was a news, there was a rumor actually. There was a rumor that a particular bank is going to close down their business activity because they are in the loss. Okay, and that particular news spread like a fire in the market. Okay, and that same day, everybody was standing in a queue. That day, everybody was standing in a queue to withdraw their money. Okay, and obviously banks never have, banks can never lend or return everything or whatever money they have at a single person. But because they have already lent money to somebody who has bought a car, or they are paying EMI, or somebody is buying a flat and they are paying on EMI, or they may have lent to some business activity, or maybe their money is like RBI or government. So there are like maybe they have investment in government bond. Okay, so there are many problems which are associated with the liquidity position if there going to be a rumor. So that's why government takes a guarantee that your money is safe with the banks. Okay, and to ensure that RBI keeps central control over banks, like what should be a liquidity ratio, okay, what should be your cash ratio, what should be your cash ratio. Okay, so different things like by ensuring statutory liquidity ratio. Okay. So there are SLR. There are many things, many parameters for which RBI keeps control of banks, and that is how a depositor or the citizen is secured or assured about its safety of its money in the banking system. That's why even after having the lowest return, people prefer investing into bank because there is something which government is uh, assuring us. Okay, recently government has thought of launching one law where government was saying like due to a lot of NPS or negligence from bank officers, they are not looking for mortgages. There is substandard assets which against which loan was given, and there was a huge corruption into a banking system. So to avoid that, government tried to introduce one bill, but immediately there was a lot of repercussion, a lot of opposition from not only from opposition party but people or those who are in the banking sector, economic sector. They have opposed this move, and government has withdrawn that bill. Okay, that this bill was financial insurance and depositors guarantee. Some bill was there. Okay, FRDI. So this particular bill was introduced, and immediately government has realized the moment we will say that we are not going to get or we are not going to take guarantee of any bank, then obviously people will rush towards banks and they will withdraw all their money, and banks will not be in a position to give or to return everybody's money because this is something which is already given with their lender. A similar case study you can think about a non-banking financial institutes. Okay, recently there was a big issue with non-banking financial institutions because wherever like non-banking financial institutions gets loan from either government or from RBI or from banks. Okay, but they give like NBFCs, they give loan to long-term investment like maybe construction of roads, okay, or big project. So normally their gestation period is also very long. Gestation period in the sense by the time you get your money back, okay, that time is very long. But banks are dependent on the RBI or government. Obviously, they need money at a certain time. So maybe there was a clash between NBFC and the bank's requirement. But again, government care like each year they found a middle path, and they monetize the banking system with a 2 lakh crore to ensure that there should not be any pressure on NBFC. Okay, so this is one of the important of ratio analysis. Why we always need to have a ratio in front of you to understand our exact position. Okay, profitability obviously, like we have discussed about the profitability ratio. When you understand how much money you are putting and how much returns you are getting, you will be assured of your profitability. Okay, if you have suppose multiple options, you can decide where you have a best ratio analysis. You can decide where to invest whatever surplus your solvency level, financial stability is how much input you have, how much liquidity assets you have, how much your output you have, how much is your output compared to input, how much of your debtor compared to creditor. So that will show your financial stability. If your creditors are more than debtor, then obviously you are in a loss making company. If your debtors are more than your loss making company, your creditor, then obviously you are in a better position. Okay, what is your NPA? NPA is what non-performing assets. That ratio, like 100 as to 10, they are giving 100 rupees. Only there is a 10 rupees or 100 is on 90 rupees. So you can understand, like if you are giving 100 rupees loan, 90 rupees is coming back. That means 10% is your NPA. So that shows a financial stability or financial status of any bank. Okay, more your NPA, non-performing assets, that means you are in a bad position. Okay, so obviously ratio will show your financial stability too. If you have understood about NPA, then it's okay. If you have not understood non-performing assets, then I will suggest Google it, because this is something which is very important, and continuously you will go through NPA. Wherever you read any newspaper, or whenever you try to find reasons behind this economic instability, wherever you go for a loan to banks and the bank is denying you loan, that all credited to NPS, because banks are also under stress, or they are also into tension to ensure that with 200% guarantee that the money is going to come back to bank. Okay, even if they have 1% out, they will not give you loan. Okay, so to ensure a better financial stability of a banks, what they are doing, they are ensuring there should be better mortgage, or there should be better solvency. Quality of the management, obviously, if your ratios are good, if your ratios are showing towards profitability, what it shows, your management is of a better quality. If they are having a lesser input but the higher output, okay, that shows efficiency of management. How much inputs are they required, because they are requiring to yield a particular output. If they are incurring lesser input but they are giving higher profit, that means management is very efficient. They know how to save their resources, where to invest their resources. Safety and security of the loans and advantage to be already been provided. Okay. Solvency ratio. If your solvency ratio is good, then obviously there is a security of the loans and advances which you have lent to somebody. If you don't have, if you are giving a loan of say 1 lakh rupees, and what assets you have is only 70,000 rupees, so that means there is a high chance that person will not repay your loan. Why? Because anyhow he knows or she knows that if I don't pay my loan, obviously bank will take my property, and that property is definitely less than what amount is due on me. So based on the quality of assets, okay, if you look at the Lehman Brothers crisis, okay, Lehman Brothers crisis, which happened in 2008, the reason for slowdown in US and ultimately on a global economy, the major reason was substandard loans, okay, or subprime crisis. Okay, this is called subprime crisis. Okay, assets were of a lower quality or lower value, and the loans which were given, like that is because of artificial increase in rates of reality sector. Okay, so artificially they have increases the prices of assets, and ultimately people were ready to buy at any cost, and they have increased the interest rate. Bank were thinking like they are going to make a huge profit, but under that they have not seen what kind of mortgage is there. Okay, so there were a substandard of mortgages. The price of real estate was not as per the market price, and it was inflated price. Ultimately, people have realized that I'm not going to get this much of money. Okay, even if I have to sell this project. So rather than returning your money, they have said to banks, come and take my flat. And obviously, bank will mortgage it. Bank will call for a bidding, but ultimately, banks have not received the money which they have actually lent to the original person. So a big bank like a Lehman Brothers. So if they are going into loss, that will have impact on everything. So this is how it led to a subprime crisis, or this is having a strong relationship between different ratios which we have. Like if you are giving a loan of 100 rupees, definitely you're supposed to have a safety of 120 rupees. But if your safety is 80 rupees and you are giving a loan of 100 rupees, so there is a high chances of getting a converted of this loan into NPA. non-performing assets. Okay, we are going to start a new chapter, but that will take again comparatively at least say 7 to 8 minutes, and we are left with only 2 minutes to, to do with our fund flow and cash flow. But I will give you this little background about cash flow and fund flow. Cash flow, this statement shows cash inflow and outflow, whereas fund is about assets. This statement shows fund flow and outflow during a year. Okay, fund flow in the sense maybe it's not only about the cash, but cash flow that is you required on a daily basis. Okay, whatever money you have received on that particular day or particular month or particular year, and what amount you have paid outside. Okay, but fund flow is not only about the cash amount, but it is about the long-term assets. How many assets you have bought this year? Like if I have tell you a story about the Baidu, okay, maybe they were in loss in 2017, but if you look at like maybe they are in loss in terms of cash flow, but if you look at about a fund flow, they were in a profit. How come they will be in loss in terms of cash flow, or how they can be profit in the fund flow? So whatever cash they have paid to their teachers, their offices, whatever real estate they bought, okay, that was something where they paid a huge amount of cash to outsiders rather than how much or whatever money they have received from their students. Okay, but in terms of fund flow, they have made a lot of assets. Okay, in that period, they have made their building in Bangalore. Maybe they have bought a lot of softwares, assets. Okay, fixed property, which they require to conduct their business. So in fund flow terms, definitely they made a huge profit, but in terms of cash flow, they made some loss, or maybe they were not able to manage whatever cash was going outside and whatever cash they were getting inside. Okay. Purpose of this is to analyze liquidity of the fund. So obviously you will understand what is my liquidity. If today suddenly some creditor comes to me and he ask me money, do I have that cash to repay to pay to that creditor or not? The purpose of fund flow is to analyze working capital of fund. Okay, so you understand what is my long term. It is not only about a cash flow, but it's not about a liquid money, but it also has a liquid plus other assets. Component 3 section, cash flow from operating, financial and investing. Okay, so whatever you finance, you have a long term, whatever you have funding from regular activity, or whatever fund you have for daily operating business. But in cash fund flow, 2 sections: application to fund and source of fund. Okay, so purpose of fund flow is to analyze working capital of a firm. So whatever money you required for working capital, like maybe 1 month, 2 months, to conduct a particular activity, whatever fund you have, because maybe cash, maybe you are shortage of cash, but you have something as a fund, like maybe you are going to get money from a creditor in the next 1 month or 2 months. So in that case, maybe that money which you are going to get from a debtor will not be included in cash flow, but that will be included in fund flow. Okay, components: cash flow from operating, financial and investing. 2 sections: application of fund and source of fund. Okay, so fund itself says cash is only a cash component, but fund is comparatively larger fund. Like maybe you are taking a fund from bank, maybe you are taking from equity, maybe you have something to come from creditor, something to give to creditor, something to receive from a debtor. So there are 2 things: application of fund, what is utility, and source of fund, like where you are going to invest or how you are going to source your funding. Calculate net cash position of a firm. Calculate the working capital position. Maybe in terms of cash flow, you will consider what you have in your hand. Okay, what cash you have in your hand. But when you go for a fund flow, you will see cash in hand or cash at bank. Or when you go for a fund flow, you understand what is your exact position. How much money is receivable and how much you are there for payable. So whatever you have a difference, that you calculate in terms of fund. Reporting: mandatory for companies to report as per the GAAP. Okay, not mandatory to report this statement, but can be made internally. Okay, like you have to mention about the cash flow statement when you manage it. But when you talk about fund flow, because it's not mandatory. Why it's not mandatory? Because there are different ways you can calculate your fund flow. There are different ways you can calculate your fund flow. Something you are going to receive payable or as a receivable. Maybe there be some kind of manipulation, there can be some kind of changes. So there is no certain position in terms of fund flow. Okay, there can be changes at the end, but in terms of cash flow, there cannot be changes because you are measuring what is there in your hand. Okay, you cannot lie like this is my this much money I have in cash, this much money is in the bank. So this is your cash statement. So that can be mandatory, but fund flow cannot be mandatory, or because there can be different ways to calculate fund flow. There can be changes ultimately.